You may have seen the headlines in the previous week about something pretty odd going on in the stock markets about GameStop. This wary chain of retail stores that sell video games had its stock mounted hundreds of percent in a matter of days. In today's video, Next Day Story will be answering your wonders about what's really going on out there. Buy low, sell high is the ultimate formula for making money on the stock market, but that doesn't deny the fact that you can't make money when a stock goes down. The term for this kind of trading is called shorting a stock. That's when you're betting that the company's stock will fall. It's a little tricky, but don't worry dear viewer, you'll get enough sense on how this kind of trading works by the end of the video. The perfect approach of people taking such risks is by studying and staying updated about the situation of stocks in a certain company. And they're pretty much convinced that these stocks are going to drop down to a certain extent sometime in the near future. So when the stock is high, they borrow shares from their brokerage with an interest and then they sell them. Technically, they still owe those shares to their brokerage. So they wait for the price of the stock to go down. Then they buy them back for much less money. They return the shares of their brokerage and voila, they've just made money. But the nightmare will be if the price of the stock went up in the meantime. In that case, you're literally in quicksand. GameStop is a video games retailer that has been weakened by the pandemic. Hedge funds had shorted GameStop, since no one's buying video games in a brick-and-mortar store anymore. GameStop shares hit a low of $2.57 last year, before rising to $18.84 by 31 December after a notable hedge fund decided to back the company. The price rose bit by a bit, but still other funds were betting against GameStop by short-selling big numbers of shares. The slaughterhouse for the hedge funds opened when a bunch of amateur investors of the subreddit Wall Street Bets joined the game, wanting to teach lessons to the hedge funds that were seeking to profit from a company's troubles. Other users joined the fray in order to make solid money. Some of them made millions on paper while the hedge funds were freaking out. One of the hedge funds, called Melvin Capital, had to borrow almost $3 billion to cover its GameStop share. The army of Redditors sent GameStop shares to a parabolic level. Any of the short sellers that had borrowed GameStop shares at the beginning of the year and sold them in the markets for $18.84 needs to find another $301.16 per share to buy them back again and return them to their owner. The troubles doesn't stop at this point. There's another nightmare called the short squeeze. Since some hedge funds had borrowed and sold millions of GameStop shares, they had to buy the shares back to prevent the escalating losses. But buying the shares back created additional demand, pushing the price sky high. If you like the video, make sure to subscribe and turn on notifications for more interesting stories and facts. I'll see you in the next video. Take care.